Welcome to today's Explainer, where we're going to break down absolutely everything you need to know about India's biggest asset management company IPO, SBI Funds Management. So the absolute biggest AMC in India is finally hitting the stock market, and it's easily one of the most anticipated public issues we'll see in the financial services sector for 2026. But, behind all the hype and that massive, iconic brand name, what's actually driving the engine of this business underneath the hood? Here is our quick agenda for today. 1. The big IPO snapshot. 2. Decoding the AMC business. 3. Strengths and growth drivers. 4. The hidden market risks. And 5. Peers, valuation, and verdict. Because ultimately, this is the million-dollar question, right? Should you actually invest in the SBI Funds Management IPO? Let's sift through the raw facts, the long-term prospects, and the valuation to figure this out together.
Section 1. The big IPO snapshot. Key details.
Okay, so first things first, the price band per share for this issue is set strictly between 545 and 574 rupees. And if you're looking to jump in as a retail investor, the minimum application size, which is known as a single lot size, is exactly 26 shares. You literally can't apply for anything less than that. So if we just do some quick math on that, multiplying those 26 shares by the upper end of the price band translates to a minimum investment of 14,924 rupees. Basically, just shy of 15 grand is your baseline entry ticket. But hold on, before you go allocating that capital, there is one absolutely massive detail about how this specific IPO is structured that you really have to understand.
This IPO is a 100% offer for sale, or OFS. So what does that actually mean for you? Well, it means absolutely zero new shares are being created to raise capital for the business. Instead, the existing shareholders, which in this case are the State Bank of India and Amundi, are essentially just cashing out a portion of their current stake. So your money, it goes directly into the pockets of those exiting shareholders, not to the company's balance sheet. The company itself gets exactly zero funds from this huge IPO.
Section 2. Decoding the AMC business, how it works. Before we even look at the financials, we need to grasp how an AMC actually makes its money. And honestly, it's a beautifully simple machine. Step 1. Everyday investors like you and me pool our money into mutual funds. Step 2. The AMC's financial experts take that pool and decide where to deploy the capital in the market. But Step 3 is where the magic happens. The AMC charges a percentage fee on that total pool of money, which we call an expense ratio. So as the total assets under management grow, either because more people are investing or just because the market itself is going up, that fee income scales up exponentially. It creates this incredibly powerful operating leverage for the company's profitability. Now, why is this machine in overdrive right now? Well, India's going through a massive cultural shift. We're seeing way more financial awareness and this absolute boom in monthly SIPs, systematic investment plans, where folks are treating investing almost like a monthly utility bill. Add in these highly accessible digital platforms that literally put the stock market in everyone's pocket. And maybe most importantly, there's a generational shift happening. People are moving their savings away from traditional physical assets like real estate or gold and pouring it into financial assets like mutual funds. This is creating a huge long-term tailwind for AMCs. Section 3. Strengths and growth drivers, the bull case. So how is SBI specifically positioned to ride this wave? Well, they are the absolute undisputed market leader in India by mutual fund average assets under management. That scale provides immense economic leverage. Plus, they're backed by the deeply trusted SBI brand name, which is huge. I mean, trust is everything when you're asking people to hand over their life savings, right? They also aren't a one-trick pony. They have a highly diversified portfolio covering equity, debt, ETFs, and portfolio management services. But their biggest moat? For sure, it's their unmatched nationwide distribution network that completely leverages SBI's vast banking footprint across the whole country. And on top of that brand and distribution, the underlying business structure itself is phenomenal. Think about it. Unlike a heavy manufacturing plant that constantly has to build new factories or buy expensive machinery, an AMC is an asset-light business. No heavy lifting, no massive capital expenditures. And that typically translates directly into really healthy profit margins, strong return ratios, and just excellent, consistent cash generation for the shareholders.
But hey, let's pump the brakes for a second. No investment exists in a vacuum. We absolutely have to weigh these formidable strengths against the inherent vulnerabilities of the financial sector. An asset-light market leader sounds perfect on paper, but we need to look at the other side of the coin.
Section 4. The hidden market risks, the bear case. Here is the reality check. And AMC's earnings are totally inherently market dependent. If the broader stock market crashes or we hit a prolonged bear market, two bad things happen simultaneously. One, the sheer value of their managed assets drops, which immediately reduces their fee income. And two, everyday investor sentiment sours, meaning that fresh money just stops flowing in. On top of that, this whole industry is heavily regulated by SEBI. If SEBI suddenly changes the rules and caps expense ratios, that directly slashes the AMC's profit margins overnight. And finally, the competition is absolutely intense, not just from the old legacy players, but from these aggressive, new-age, zero-fee digital platforms fighting tooth and nail for the exact same retail investor.
Section 5. Peers, Valuations, and Verdict. The final analysis.
Now that we've got the mechanics, the tailwinds, and the risks dialed in, let's put SBI Funds Management in the ring with its biggest competitors. Notice how, yes, SBI boasts the undisputed largest AUM and an unbeatable distribution network, but you can't ignore the others. HDFC AMC brings incredible premium profitability and a top-tier brand. Nippon Life India commands massive retail participation. UTI has this huge, generational operating history, and Aditya Birla offers uniquely diversified products. The takeaway here? You can't rely on a brand name alone. You have to see who is actually squeezing the most performance out of the assets they hold. And that brings us to the ultimate truth of investing. A phenomenally great market-leading company can actually be a terrible investment if you pay too much for it up front. You have to benchmark specific valuation metrics, price to earnings, price to book, return on equity, and market cap, directly against those peer multiples we just talked about. You need to be sure that whatever premium you're paying for the SBI brand is actually justified by their underlying financial output when compared to, say, an HDFC or a Nippon.
Oh, actually, quick pro tip before we wrap up. Here's a surprising fact that often gets buried in the fine print. If you already hold shares in the parent company, the State Bank of India, you might have a totally separate avenue to apply for this IPO. There's a special shareholder reservation category, which could potentially give you a slightly better statistical chance of actually getting an allotment in what's expected to be a wildly oversubscribed issue. So definitely look into that. All right, so we've walked through the whole shebang. The mechanics, the massive scale of their AUM, the beautiful asset-light advantages, but also the undeniable reality that their revenues are completely tethered to the unpredictable mood swings of the stock market. Based on this 360-degree look at their market dominance versus those cyclical sector risks, we want to hear from you. Does this AMC fit into your long-term wealth-building strategy? Or do you think you'd just be paying a premium for a brand whose profits will ultimately be at the mercy of the next market crash? Let us know in the comments below.